In this episode, we'll be talking about what a 401k is, how it works, and how to invest in it. 401k, very simple. It's basically just investment account while you're an employee. It's chosen by your employer. You are employed and your employer offers 401k. This is a pretty common practice. Most employers offer 401k depending on where you work. Okay, you have a 401k. What do? First, you got to know, does your employer provide a 401k match? Matching is basically they'll match you dollar for dollar on your investment up to a certain amount of investment. Okay, let's just say they will do 100% match up to 10%. Let's say you make $40,000 a year, so like roughly $20 an hour, and you multiply that by 10%, you are contributing $4,000. So that means they'll match 100% of this. So they'll match another $4,000. That's $8,000 that's going to this 401k. That's free money that they're giving you. Obviously, you can't just quit. Most companies have like a clause that says you have to work for at least 2 years, which means like you got to work for 2 years or else we won't give it to you because we're not just trying to give you free money that you can run off with, which makes a lot of sense. So, number one, look for the match. It's very important to look for a match because usually that'll determine whether or not you want to put money to a 401k. I mean, obviously putting money to a 401k is always a good idea, but some people, when there's no match, will suggest that you don't do it because it's not as good as some of the other investment options that you have, but it's still pretty good because if your employer offers good funds, then get your taxable income reduced and pay less taxes at the end of the year. This is tax deferred and pre-tax dollars. So basically that $40,000, you contributed the 10%, your taxable income will be reduced by that $4,000 that you put into that 401k. So really you get taxed on $36 instead of $40,000. So that's what I mean by tax deferred and pre-tax dollars. That's kind of like a really dumbed down version of that. But the downside is, let's say you invested $4,000. Let's just say it grows to $6,000. That means you have $2,000 in gains, which means that when you pull out at some point, you're going to be taxed on these gains. These are capital gains. So it would be like 15% or something like that if you held for a whole year, which you would be because it's a retirement account. So you would get taxed 15%. Your take home for this would be like $1,700. So you would get $1,700 after tax. So that's how it works. So it grows tax deferred. You get to put money in before paying taxes on that money. And then later you have to pay taxes on that money. That's why it's deferred. You're holding taxes off until later to pay them. And why would you do that? Well, 401ks have a higher amount that you can contribute. 19,500, whereas both traditional and Roth IRA, they share $6,000 total to either, right? So it's not like $12,000, it's $6,000 Roth or traditional. So 401k, you put in your 10%, they take out 10% every single paycheck. If you make the $40,000 and divide that by 12, you make $3,300 a month. We divide that by 2 because generally you get paid bi-weekly. You multiply that by 10%, you are contributing around $166 per pay period. So you're contributing around $333.33 per month. And then let's say they match. So they're going to give you another $333 every single month. So you basically have an investment of $600 every single month. So that's how it works. And then so once you have the money in there, right? It's not like you just put money in a 401k and then you are like, oh yeah, it's going to grow over time. No. The way it works is you have to choose funds. What are funds? So when you look in your 401k, your employer would have chose a couple of different options to invest in. So you have to actually do a little bit of research and see what your employer offers because every single employer offers something different and they go with different investment firms or brokerage firms. So some employers use Vanguard, some employers use Fidelity, some use Schwab. And so when you're choosing funds, you want to look for those index funds. That's what people would suggest. Index funds are easy because you don't have to like pay a lot of attention and you don't pay a ton of fees on the money that you leave in there. Other things are target date funds. And then if you're like older, because a lot of the times when you get older, you want to be safer with your investments. So stocks in general are a little bit quote unquote riskier because market swings up and down year to year. And if you're closer to retirement, you really don't want to be on a downswing when you're trying to retire. So we choose funds, index, target dates, bonds, et cetera, et cetera. You're going to see all of that inside your 401k. Right? So when you look for index funds, a lot of good options are total market. This will track the entire US market and it'll give you exposure to like all areas. So you don't really have to think that much. Sometimes they don't have total market. So you're going to have to do like a mixture of large cap, mid cap, small cap to get exposure. I mean, this might be a little bit excessive, but this is another way to track indexes, or you can start to look at other funds. But the way that I like to invest is I use index funds because it's just easier and I don't have to track it and be super stressed out about it. I just put money in and I hope for the best. So target date funds, you'll see target date fund and it'll give you like a year, like 2065 or something, a mixture of stocks and bonds, right? And let's say because you're so far from retirement, it's probably going to be something like 90% stocks and like 10% bonds. But then over time, as you get closer to retirement age, it'll start to rebalance. So then like, let's say you get a little bit closer and it's going to be like 70% stocks, 30% bonds. And then over time, it'll be like, I don't know, let's just say 30% stocks, 70% bonds. Because once again, bonds are safer investments. They give you a fixed rate of interest, whereas stocks can go up and down. And as you get older, you definitely want to try to keep as much of your money without having to worry about, oh, next year we're in a recession. Boom, all my money is down like 20, 25%. I'm like not having enough money for retirement. So that's how target date funds work. You put money in a target date fund. Over time, it rebalances as you get closer to the date that it says for retirement, and then it rebalances for you. But the amount that you pay in management fees is a little higher, but usually target date funds aren't too much higher. Next is bonds. Once again, we talked about bonds a few times. It's usually a fixed amount of interest over time, and then you'll probably see a bunch of other different investment funds inside your 401k that you can decide that you want to use or not. And that's 401k. One thing I do want to cover with the 401ks, the Roth, and the traditional, remember that these are retirement accounts. The money you put in here, you don't want to touch any of this money until you're at retirement age, because there's penalties and taxes if you pull out before retirement age, right? You get 10% penalty and then you get taxed at whatever rate. You don't want to like pull out 100k, then 10k if it gets to 10% penalty, you lose 10k, so you only get 90k of the thing, and then you get taxed on it, which is, let's just say, another 10%. So then you only get like 81,000 out of the 100,000 that you took out. So that's why you don't want to take these out before, I think it's like 59 and a half. So if you put money in here, just leave it in there and let it grow until retirement, and hopefully you'll be rich in retirement. You really want to keep your money in the market long term because you have more time to grow or financially recover from issues. Once again, this is not financial advice. I'm not telling you what to do. I'm just giving you options on the things that people do in general, and just to educate you on all some of this stuff that they don't teach you in school. Check out the Discord server. I'm still working on it, but I will be posting a budget template in Excel or on Sheets if people need it on that. There is other social media now. I use Twitter, I use TikTok, I use Instagram, I use all of that. So make sure to follow and check those out in the links below, and subscribe to the YouTube channel for more content. Thank you so much, guys, for sticking it out with me, and I hope you guys learned something.